The market didn't take your money. Your own mind handed it over. Most investors misunderstand the nature of their failure from the very beginning. They believe they are fighting the market, but in reality, they are fighting themselves, without realizing it. Throughout their investing lives, they focus almost exclusively on what is outside. They fight charts, they fight prices, they fight news, they fight algorithms, they fight whales, they fight the system. They believe the problem is complexity, or manipulation, or lack of information, or unfairness. So they respond by trying to learn more, react faster, predict earlier, outsmart others. But while they are busy fighting external forces, their real opponent operates silently, continuously, and invisibly inside their own cognitive and emotional system. The market does not destroy most investors. Their own minds do. 1. The core misdiagnosis: why investors get the problem wrong. Every failure begins with a wrong diagnosis. Most investors believe losses are caused by bad timing, bad assets, bad information, bad luck. This belief is appealing because it frames failure as situational. But investing failure is rarely situational. It is structural. It originates not from what the market does, but from how the human brain reacts to uncertainty, risk, and loss. The market is merely the environment. The investor's mind is the operating system. And most investors are running an operating system that is fundamentally incompatible with uncertainty. 2. The most comfortable lie investors believe. The most comforting belief in investing is the idea that the market is the enemy. This belief persists because it performs an important psychological function. It protects identity. Ask losing investors what went wrong, and you will hear the same explanations. The market is manipulated. Retail never stands a chance. It's rigged against small investors. Whales and algorithms control everything. Notice what these explanations do. They shift causality outward. They imply, if conditions were fairer, I would succeed. This belief feels good because it gives pain a villain, it gives loss a story, it gives failure a narrative. But most importantly, it removes responsibility from the self. If the market is evil, unfair, or hostile, you don't have to examine your thinking. You don't have to question your behavior. You don't have to confront your own emotional patterns. You don't have to change. Here's the truth that most investors resist at a deep level. The market does not know you exist. It does not know where you entered, where your stop loss is, how large your position is, how emotionally attached you are, or how badly you need to be right. The market does not care about your hope, your fear, your confidence, your desperation. The market is not watching you. What feels like a personal attack is simply your own internal state being exposed by volatility. The market is not hostile, it is indifferent. This matters more than it seems. An enemy has intent. Indifference does not. You can negotiate with an enemy. You can anticipate an enemy's strategy. You can even learn from an enemy's patterns. You cannot negotiate with indifference. Indifference offers no feedback, no mercy, no validation. It simply continues, and the human brain finds this deeply unsettling. Blaming the market is not stupidity. It is biology. The human brain evolved in environments where survival depended on identifying threats quickly, attributing cause clearly, and responding decisively. Our nervous systems are optimized for predators, enemies, visible danger. Markets provide none of these. Instead, markets present abstract risk, delayed consequences, probabilistic outcomes. When money is lost, the brain experiences pain, and pain demands explanation. An external enemy feels safer than an internal flaw, because if the problem is outside of you, you don't have to confront uncomfortable truths about yourself. Impulsiveness, emotional reactivity, overconfidence, intolerance of uncertainty. But here is the fatal contradiction in this belief. If the market were truly the enemy, no one would survive it long term. Yet many do, not dramatically, not heroically, quietly, boringly, without spectacle. They are not geniuses. They do not predict better. They do not have superior information. They simply manage themselves better when uncertainty appears. After decades of observing investor behavior, one conclusion becomes unavoidable. Investing is not a financial game first. It is a psychological game with financial consequences. The market does not defeat people. People defeat themselves. Every blown account follows the same internal sequence: emotional exposure, behavioral distortion, delayed accountability, amplified loss. The chart does not create mistakes, it reveals them. The market does not inject fear, greed, or impatience into you. It simply applies pressure, and pressure exposes what already exists. Markets are dangerous not because they are unpredictable, but because they interact directly with the human nervous system. Trap 1. Intolerance of uncertainty. The human brain seeks certainty, closure, and narrative. Markets provide none of these. Uncertainty creates cognitive discomfort. The brain tries to eliminate that discomfort by inventing explanations, overweighting recent information, and perceiving patterns where none exist. This leads investors to chase trends only after they are obvious, panic during normal volatility, overweight confirming news, and ignore disconfirming evidence. Your brain is not trying to make you wealthy, it is trying to make you feel safe. And in markets, feeling safe is often the most expensive illusion of all. Trap 2. Action bias disguised as control. In everyday life, action often restores control. In markets, action often destroys it. But the brain does not distinguish between these domains. When prices move against you, the brain experiences threat and demands immediate response. Fix it. Do something. Act now. This produces overtrading, revenge trading, premature exits, and impulsive re-entries. In markets, unnecessary action is not neutral. It compounds error. Doing nothing feels weak. Doing nothing feels irresponsible. But this is a misinterpretation. In markets, inaction is often a sign of mastery, not passivity. Trap 3. Ego preservation over capital preservation. This is the most destructive trap. Your brain values identity more than money. Being wrong is not merely a financial loss. It is a threat to self-image. So when a trade goes against you, the brain responds by rationalizing, delaying acceptance, reframing reality, and increasing commitment. Loss becomes personal. You stop asking, what is the correct action now, and start asking, how do I avoid admitting I was wrong? This is how small losses become catastrophic, not because the market forces them, but because the mind refuses to accept reality. Here's a truth that intelligent investors find particularly difficult to accept. High intelligence does not protect you in markets. It often accelerates your downfall. Why? Because intelligence enhances narrative construction, rationalization, and post hoc justification. Intelligent investors can explain bad decisions brilliantly. They can defend losing positions logically. They can remain wrong for long periods, very intelligently. The market does not reward explanation. It rewards correct behavior. It does not care how elegant your reasoning is. It only cares about exposure, behavior, survival. Losses feel personal because the market does not just take money. It reveals impatience, fear, greed, ego. The market functions as a mirror. Most people do not like what they see. So instead of changing themselves, they try to break the mirror. The market is neutral. Your brain is not. Every mistake blamed on the market has an internal origin. Entering too late, exiting too early, oversizing positions, hesitating, chasing confirmation. The market provides conditions. Your mind provides reactions. Once this is truly understood, a permanent shift occurs. You stop asking, what will the market do, and start asking, what will I do if I am wrong? That single shift redefines everything. The final reframe, survival over victory. The market is not something you defeat. It is something you coexist with. You do not win by overpowering it. You survive by aligning with its nature. Once this is accepted, urgency fades, comparison disappears, emotional volatility softens. You stop trying to beat the market and start trying to avoid self-destruction. The market is not watching you. It is not targeting you. It is not teaching you a lesson. It is simply doing what it has always done. The only real enemy in investing is the part of your own mind that cannot accept uncertainty. Once you understand that, you stop fighting the market and start surviving it.